Hi there, and thank you for joining us here at PhillipCapital's Market Watch. I'm Yi, Business Development Manager for Forex and CFDs from Phillip Nova. Global interest rates have been on the rise since March 2022 and are likely to persist in the near to middle term of 2024. Apart from using fixed deposits or bonds, you might be wondering if there is another way to capitalize on this trend. In this episode, I will be sharing how you can use leverage Forex as an instrument to supercharge your returns in a high interest rate environment. While central banks of most major economies have embarked on tighter monetary policy, specifically by adjusting interest rates to combat rising inflation, some central banks have adopted a contrarian approach by maintaining their interest rates close to zero. A prime example is Japan, where lending rates have remained steady at negative 10 basis points during a period which US interest rates have increased by 505 basis points across 11 rate hikes, breaking a 22-year high record. Against this backdrop of large interest rate differentials between two countries, an opportunity arises for the strategy known as carry trade. In essence, a carry trade involves selling the currency of a country with a lower interest rate and buying the currency of a country with a higher interest rate, thereby profiting from the interest received. For illustration, imagine borrowing $10,000 at 2% per annum interest rate and converting it to USD at the rate of 1.3300, then loaning it out at a 5% per annum interest rate. At the end of 1 year, you will owe $200 in interest and receive $375.94 in interest. Assuming no change in the conversion rate, the notional loan of $10,000 will be returned, leaving you with the net profit of difference in interest received and interest paid. The same outcome can be achieved using leverage FX by going long on dollar-sing pair. However, the use of leverage will amplify potential gains or losses, as the same amount of money is now used as a collateral to control a larger notional sum of money. Using the same example, with $10,000, you can control a position worth up to $200,000 worth of USD at a 5% margin. This equates to $150,376, yielding an interest of $7,518.79 instead of $375.94 at the end of 1 year. Apart from a lower capital outlay, there are other distinct benefits to using leverage FX to perform a carry trade. Firstly, there is no minimum lock-in period, providing you flexibility in deploying your funds. Secondly, you can participate anytime within the Forex market's 24/5 operations. Thirdly, interest is paid out on a daily basis and there is no need to shift your funds between different accounts or currencies to perform carry trading. Finally, potential price appreciation can accelerate profits when the market moves in the favor of the trade direction. When undertaking this strategy, there are two key risks to be mindful of: market risk and leverage risk. Market risk arises from the movement of prices in the underlying currency pair. In the previous examples mentioned, earnings from interest differentials could be eroded, or even potentially turn to losses when price moves in the opposite direction of the trade. Leverage risk works in tandem with market risk. If price moves significantly in the opposite direction of a trade, a margin call may be issued. This happens when account balance falls below the minimum required to maintain open positions, and failure to meet margin call may result in closure of positions, leading to potential loss of capital. And that's all for this episode of PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Also, tell us what you think. Will you be using CFDs to ride the current market volatility? Leave your comments. Thanks for joining us and we'll see you soon.